Bonds, like stocks, are a key component of a diversified investment portfolio. But unlike stocks, they're considered a lot less exciting and sometimes even more difficult to understand. So here to take us through the bond market is Daphne Botha, portfolio manager at Futuregrowth Asset Management. Daphne, what exactly is a bond?
Okay, so there's various different kinds of bonds. Let's just start there. If we focus on a vanilla bond, we're talking about an instrument, say it's a term of 5 years, that's going to give you semi-annual, so twice a year, cash flows, and you're going to get your money at the end.
As far as I understand, it's sort of like an IOU, isn't it? Because you're buying debt, somebody else's debt, you're kind of guaranteeing that?
So it is debt, yes. So issuers like the Republic of South Africa, i.e. our own government, will come to the market. They'll say, okay, we need to raise R1 billion. In fact, they auction every Tuesday. They say, market participants, are you interested in buying these bonds? And then market participants will then go and bid for the bonds at the rates they feel that it offers value.
So we're buying debt. How exactly do you make money by doing this?
There's the income that you earn, or the coupon rate. So, for instance, if you take one of our older bonds, the R186, it's a bond, government-issued bond maturing in 2026. It earns a coupon of about 13%, and it matures. So, as I said, matures in 2026. So, every 6 months, on the 21st of June and the 21st of December, you'll get your coupon. So, say you've bought bonds worth R1 million, you'll get the coupon on that R1 million at the coupon rate. And so that's the one component of return. The other component is capital gains and losses. So what you want is you want to buy, same with any investments, you want to buy the instrument when the price is low, and you want to sell the instrument when the price is high. Bonds work the same way, except that with bonds, you're dealing with yields, not prices.
Okay.
And there's this inverse relationship between price and yield. What I mean by that is, so when we say prices are low, what that means in bond terms is that yields are actually high. So you want to buy bonds when yields are high, and you want to sell bonds when yields are low or prices are high.
Okay, you've also talked about how different bonds have different terms of maturity.
Yes.
How does the term of the bond, whether it be 5 years or 25 years, affect the return?
Well, in theory, the longer you invest for, the more return you want. So that's normally how the bond market works. They call it the term premium. So you're happier to accept a lower return on an instrument maturing in 1 year. But, if you're going to keep my money locked for 25 years, I want a much higher return. Because with each year that passes, the risk increases.
And why is it that the risk increases?
Well, so one of the big risks with investing in fixed income or bonds specifically is default risk. Okay, so I've lent R1 million to government. With each day that passes, I run the risk the government actually doesn't pay me my money back. So the longer that term, the higher the risk of that event occurring. So that's why you want to be compensated for that additional risk that you're taking with extra return as the term increases.
Okay, that makes a lot more sense to me. As you said, there's so many different options out there. You've got government bonds, corporate bonds, even bonds offered by state-owned companies. What are some of the factors that investors should consider before deciding which bond is right for them?
When you go into the different issuers of bonds, we're talking about a different field of fixed income investing called credit investing. Because you're now you need to compare the different issuers and their relative credit worthiness. So in South Africa, for instance, the South African government has sort of the highest credit rating because government can go to the South African Reserve Bank and say, you know what, we need money, can you print money for us? No other institution in South Africa can do that. If, for instance, I go to a corporate, let's take, so Toyota issues bonds in the domestic market. if Toyota needs money so we've lent money to Toyota, in 5 years' time, they need to give us our capital back.
Mm-hmm.
On the day they need to give us our capital back, they need to have the money in the bank. They can't go to a reserve bank and say, print us money. Only the government can. So Toyota, because of that one fact, needs to pay us more
Mm-hmm.
In terms of return relative to what a government fund will pay us.
Okay.
So what we would do is we would rank all these different issues. So the SOEs, there's a difference between the SOEs that have an explicit government guarantee. Mm-hmm. So those we treat as government versus those that don't have a government guarantee. So there you need to look at the particular issuer's ability to repay you. The same with any corporate, you have to look at a Anglo's versus a Toyota versus a City of Cape Town versus, what does their financial metrics look like?
Mm-hmm.
What is their ability to repay you that bond at the time when that bond actually matures?
Okay, and you talk about all these factors that we should consider. Now, once we've considered this and we've come to a decision, how would you actually go about investing in a bond?
Okay, so the bond market is very much an institutional market.
Mm-hmm.
What that means is it's very much a space where your more educated investment professionals operate in. So for the man in the street, not really a market where you can just go to a place and say, I want to buy R1 million worth
Mm-hmm.
of bonds. For starters, most people don't have R1 million to buy buy bonds with. So for the man in the streets, normally they will go to unit trusts.
Mm-hmm.
As their way into the bond market to buy a bond fund. So we manage funds on behalf of Old Mutual, so the Old Mutual Bond Fund, and go buy that. Alternatively, the government has started issuing
mm-hmm.
bonds, retail bonds they call it. You can go to the post office or various other entities to buy that. But those behave more like a fixed deposit.
Okay.
The government says for 2 years or 3 years, give us 100,000, 5,000, whatever amount you have, and we'll give you a fixed rate of return, a fixed coupon rate over the life, and we'll give you your capital back at the end. So those are the two ways for the man in the street. Most investors see their fixed income investing via their pension funds.
Mm-hmm.
So the pension fund would have a balance fund that will have equity and fixed income. And that fixed income portion, so that's the portion of assets we actually manage,
mm-hmm.
The bulk of. So portions of a bigger pension fund.
Okay, well, you've told us about these fixed rate bonds that government offers. Now, another bond that's out there, also inflation-linked bonds. How exactly does that work, and how does it differ from the fixed bond?
Okay, that's a little bit more interesting and quite a technical area. So remember I said to you that a normal fixed rate bond offers you semi-annual, so twice yearly coupons, and you get your capital at the end. So if you give you R1 million, you earn your 10% coupon every 6 months, you get your R1 million back at the end. So in an environment of inflation, if inflation is high, that actually erodes some of that value.
Okay.
So if your return on that bond, say over the 5 years, is 8%, and inflation is running at 6%, your real return, so the difference between the two is only about 2%.
Mm-hmm.
Because inflation's eaten away some of that future value of that R1 million that you're going to get back in 5 years' time. So how inflation-linked bonds differ is inflation-linked bonds also pays you a semi-annual coupon, so twice yearly coupon, but the coupon rate is much lower. Mm-hmm. If you look at your 8% coupon in your nominal bond, in an inflation bond, you're talking more about a 2% coupon, give or take. But your return, okay, this is where it becomes a little bit more interesting. So when you get that 6 monthly 2%, you not only get the 2%, but you also get the change in inflation over that last 6 months.
Okay.
So you get the 2% plus the change in inflation.
Mm-hmm.
So that's why. So it's an investment. So not only does the coupon adjust with inflation, your R1 million at the end in 5 years' time is also adjusted by the rate of inflation over the life of the bond.
Okay.
So you don't have to now worry about inflation. You know what you're getting because inflation, the investment is adjusted by whatever the inflation rate comes at. You don't have to go look forward and try and predict what inflation is going to do.
Mm-hmm. Now, Daphne, I know that most pension funds are also very heavily invested in bonds. Is this because bonds are traditionally considered safer than stocks?
Look, it's a relatively a lower risk asset class. So equities, obviously, it's more volatile, whereas bonds less volatile. So, safer is a dangerous word to use because no particular investment is 100% guaranteed. So that's why I struggle to use that. But if you look at, so it's safer also relative to where you are in your life. So a person who is in his 20s is not going to want a lot of bonds. They want the capital growth over the longer period. So that's the thing that equities give you. Equities give you more capital growth over time, whereas with bonds, there is limited capital growth that you can get.
Limited capital growth, but more stability, isn't there?
Relative, yeah. More stability, limited capital growth relative to your equity asset class.
Is it an adequate wealth building tool, though?
Sorry?
Is it an adequate wealth building tool?
I think any balanced portfolio should have a component of it. So that's why if you look at Regulation 28 of the Pension Funds Act, it normally, on aggregate, it targets about 75% exposure to equity, 25% exposure to fixed income, give or take. There are other asset classes in there, so money market might be a component of fixed income, and then there's also property as a separate asset class. But that allocation between equity and bonds, that changes over time depending on where you are in your life. A pensioner might have more exposure to bonds because they need more the security of income as opposed to the capital growth and the volatility that equity brings. Whereas someone early on starting out in their career in their 20s will want the capital growth because they're building a 20, 30-year portfolio, and they don't necessarily want the lower growth assets of fixed income.
So, Daphne, there's also this risk that South Africa's credit rating may be downgraded to junk or sub-investment grade. What kind of impact would this have on the bond market?
The initial impact it's more a factor for foreign investors as opposed to domestic investors. So I'm talking about foreigners in pension funds sitting in the US or the UK. They might not have a mandate to invest in below investment grade debt, and they might be forced sellers of our bonds. And that's a big risk for us because foreigners hold in excess of 30% of our ZAR-denominated bonds. So that's quite a big risk if some of that actually flows out. We have seen some movement there, lost maybe about 5% last year of negative flows out of the country, out of bonds. The other thing is, so that also has a link to the rand. So if foreigners take money out, the rand remains under pressure. Obviously, that's an input into inflation. So we reckon that will